Welcome to the Deep Dive. We're here to cut through the noise and get you the essential insights on the companies really shaping our world. And today, well, we're tackling a giant, Apple Inc. They just dropped some really impressive earnings, underscoring their massive market presence. But what's really going on under the hood? Our mission today, to pull out the key nuggets from the latest financial data and analysis. We'll explore the fundamentals, the risks, and, crucially, try to figure out Apple's true value, especially looking at it through the lens of someone like Warren Buffett.
It's a fascinating company to analyze, absolutely. Apple holds such a unique spot, doesn't it? And valuing something so dominant, yet always evolving, well, means looking way beyond just the headlines.
Okay, so let's unpack those latest numbers then. Fiscal Q3 2025 ended in June. You said impressive. What stood out?
Right, they were definitely robust. Revenue came in near $94 billion. That's a record for Q3, up a solid 10% year over year, beating expectations.
10%? Wow.
Yeah, and earnings per share also topped the forecasts. Stock got a nice little bump after hours, about 2%.
So what drove that? Still the iPhone.
Oh, absolutely. iPhone sales were huge. Over $44 billion, up 13% year over year. Seems the iPhone 16 demand was really strong. Apple specifically called out a record quarter for upgraders, which is interesting.
Record upgraders, huh? And didn't they hit some massive iPhone milestone recently?
They did. Just recently shipped their 3 billionth iPhone since 2007.
3 billion. That scale is just hard to grasp.
It really is. And then their services, that continues its climb, an all-time high, over $27 billion, also up around 13%.
Okay.
And get this, well over 1 billion paid subscriptions now across their various services.
A billion subs. So it's not just growth, it's showing how well they monetize that massive user base, right?
Yeah.
Even when the overall phone market might be slowing.
Exactly. It speaks volumes about their resilience. And Tim Cook, the CEO, he touched on AI during the earnings call.
Oh, yeah. What did he say? Investing more there?
Definitely. He mentioned significantly growing R&D and AI, so they're very open to acquisitions to speed things up. And he even teased a more personalized Siri, maybe coming in 2026, using on-device AI, so they're clearly looking ahead.
Right. Playing the long game.
And it all feeds back into that famous walled garden, their hardware, software ecosystem. If you look at the breakdown, say from FY 2023, iPhone is still king, about 52% of revenue, but services, that's 22%, and it's high margin.
Very high margin.
Then you've got Mac, iPad, wearables making up the rest. This whole interconnected system, it just breeds incredible customer loyalty. And that steady recurring income leads to, well, pretty amazing profitability. Think a 25% net margin in FY 2023.
And the sheer number of devices out there.
Over 2.35 billion active devices worldwide. That's the engine. That's what drives it all.
Okay, that ecosystem is clearly a powerhouse. But no company's invincible, right? Even Apple. What about the headwinds? What are the immediate challenges you see?
Well, you always have the broader economy, right? Consumer demand can fluctuate with inflation or downturns. That's a constant.
Sure.
And supply chains can still be tricky. Remember the COVID shutdowns hitting the iPhone 14 Pro supply? Things like that can pop up.
Right, external shocks.
And more specifically, tariffs and trade policy are a direct cost. Apple mentioned about $800 million in tariff costs just in Q3 FY2025.
Ouch.
Yeah, and they expect it to be even higher next quarter, maybe $1.1 billion. They're trying to mitigate it, of course, optimizing the supply chain, even exploring more U.S. production options, but it's a definite drag.
Okay, so those are the near-term pressures. But stepping back, what about the bigger, maybe more structural risks?
Right.
The long-term stuff.
Yeah, that raises some important questions. First off, market saturation, especially in developed markets. With over 1 billion active iPhones, future growth really comes from people upgrading or switching from Android. It's not like the early days of massive new user adoption, so that naturally kind of caps the hardware growth potential, doesn't it?
Puts a ceiling on it, yeah.
Then there's the whole innovation question. The perception, fair or not, that maybe innovation has slowed a bit under Tim Cook compared to the Jobs era.
People do talk about that. Is the next big thing coming?
Exactly. The Vision Pro headset, coming soon. That's a massive test. Will it create a whole new platform? Or will it be more niche? If it's niche, Apple's reliance on the iPhone just continues.
Right.
And you also hear concerns about whether Apple is keeping pace in areas like, say, cloud AI or generative AI compared to Google or Microsoft. That could matter long term.
And regulation, that seems to be heating up everywhere for big tech.
Absolutely. Regulatory risk is huge. You've got antitrust probes, especially in Europe with the Digital Markets Act. That's forcing Apple to allow third-party app stores on the iPhone. That could really start to chip away at their services model, especially that 30% App Store commission. That's a big profit center.
Yeah, the 30% cut is legendary.
And finally, you can't ignore the geopolitical side. Apple's heavy reliance on China. It's huge for manufacturing and as market, like 19% of sales. In today's world, that concentration is a significant structural risk.
Okay, so a lot to navigate there.
Yeah.
Given all that and their massive profits, where does the money actually go? What are the big cost drivers for Apple?
It's a good question, and the cost structure tells you a lot. The biggest variable cost is cost of goods sold, or COGS. That's components, assembly, shipping for every iPhone, Mac, etc.
Right, scales with sales.
Exactly. It eats up over half their revenue, around 55%. But even so, they maintain a really strong gross margin, around 44%.
How do they manage that? Scale.
Scale is huge, yeah. Lets them negotiate hard on component prices. Plus, designing their own chips, like the Apple Silicon, that reduces reliance on others and helps control costs. It's very smart.
Okay, so that's variable costs. What about fixed costs?
The big one there, and the fastest growing, is research and development, R&D.
Ah, the innovation engine.
Precisely. It hit over $31 billion in FY 2024. Just think, a decade ago it was around $6 billion. That's a massive ramp up.
Wow, what are they spending that on? Future stuff.
You bet. Things like AR/VR, obviously the Vision Pro, autonomous systems. They're investing heavily in what's next. Then you have SG&A selling, general, and admin. That's marketing, ads, the retail stores. That was around $26 billion in 2024.
Still a lot, but less than R&D now.
Right. And here's the thing. Even with those big numbers, their total operating expenses are actually pretty low as a percentage of revenue, maybe 14–15%.
So very efficient operation.
Incredibly efficient. They have amazing operational leverage. They really know how to turn revenue into profit.
Okay, so they manage costs. Well, they're investing heavily. Let's talk about the people. Who's steering the ship, and how are they aligned with shareholders?
Well, the leadership team is remarkably stable, which is a big plus. Tim Cook, of course, has been CEO since 2011.
Right.
And many of the key execs, Luca Maestri, the CFO managing capital return, Jeff Williams, the COO, Craig Federighi on software, they're Apple veterans. Many came up under Steve Jobs. There's a lot of continuity there.
And they've delivered, haven't they?
Right.
Under Cook.
Oh, absolutely. Revenue and profit have roughly tripled under his tenure. He's steered them to just unprecedented heights, master of operations.
And are their interests aligned with shareholders? Do they own stock?
Very much so. Executives hold significant amounts of stock. Tim Cook himself has something like 3.3 million shares, worth, what, over $700 million?
Wow.
And their compensation is tied directly to performance metrics. Remember, Cook took that 40% pay cut in 2023. That was actually after shareholder feedback. Shows they listen.
Interesting. Who are the big outside shareholders then, besides the usual big funds?
Well, you have the giants like Vanguard and BlackRock holding large stakes. But the really notable one is Berkshire Hathaway.
Buffett?
Exactly. Warren Buffett's firm owns about 5.8% of Apple. And maybe more striking, Apple makes up something like 25% of Berkshire's entire portfolio. It's a huge position.
A quarter of the portfolio.
Yeah.
That's conviction. Do shareholders like Berkshire have much sway?
They definitely have influence. While institutions often vote with the board, we've seen shareholder proposals gain traction. There was one on a civil rights audit in 2022 that passed, and that executive pay vote in 2023 that led to Cook's adjustment. So yes, shareholders can shape policy.
Okay, so management seems aligned, big investors are watching. How does Apple actually give back value to shareholders, besides, the stock going up? Buybacks are a huge part of their story, right?
Oh, enormous. It's one of the defining features of Apple's capital return strategy. Just recently, the board authorized another $110 billion for share repurchases.
Another $110 billion. That's one of the biggest ever, isn't it?
It really is, and it signals tremendous confidence from the board and management in the company's future value.
And the long-term impact.
Yeah.
How much have they bought back over time?
The numbers are staggering. Over the last decade, Apple has repurchased over $600 billion of its own stock.
$600 billion.
Yeah, and the effect is profound. The number of shares outstanding has dropped by roughly 40% between 2014 and 2024.
40% fewer shares. So that boosts earnings per share automatically.
Precisely. And it increases the ownership percentage for everyone who holds on to their shares. Think about Buffett's stake. It went from about 5.6% to 5.8% between 2022 and 2024.
Without him buying any more shares.
Exactly. The buybacks effectively increased his slice of the pie. It's a powerful mechanism. It shows management believes the stock is a good investment and they're committed to returning cash to shareholders. Their stated goal is to become cash neutral over time, meaning returning excess cash.
Okay, so that brings us to the big question for value investors. What is Apple really worth? Buffett calls it the best business I know in the world. He bought a ton of it.
Yeah.
How does someone like him actually value a company like this?
Right, so we try to estimate its intrinsic value. Buffett's preferred method, conceptually at least, is discounted free cash flow, or DFCF, what he sometimes calls owner's earnings.
Okay, how does that work, basically?
You project the company's future free cash flow, the actual cash left over for owners, after running the business and reinvesting. For Apple, that was around $110 billion in FY2025 2024. Then you discount those future cash flows back to their present value using a discount rate. Let's use 10%, which is a common hurdle rate for a stable business like Apple. And you run different growth scenarios for that cash flow.
Gotcha. So what do the numbers look like?
Okay, let's run a few. If we're super conservative, assume 0% growth in free cash flow forever. The intrinsic value per share comes out around $84.
Which is way below where it trades now, around $207.
Exactly. Tells you the market expects growth. Now, let's use a nominal growth rate, say 8% per year for 10 years, then slower growth. That's roughly Apple's historical average FCF growth. That gets you an intrinsic value of about $156 per share.
Still below the current price, less margin of safety then.
Right. Now, what if we're more optimistic? Assume 12% annual FCF growth for a decade. That pushes the intrinsic value up to around $202 per share.
Okay, now we're very close to the current market price of $207.
We are, which suggests the market might be, pricing for perfection or baking in quite strong, consistent growth for years to come.
So the takeaway on valuation.
At today's price around $277, using that 10% discount rate, Apple looks fully valued, maybe even a touch overvalued. The implied return you might expect buying today, if it grows around that 8% historical rate, is probably closer to 8.5% or 9%, not the 10% we used as a hurdle.
Interesting. So if it's not obviously cheap now, how does Apple stack up against Buffett's famous checklist? The rules for a great company separate from price.
The checklist.
Yeah.
This is where it gets really revealing about why Buffett likely made an exception on price. Let's run through it.
Okay.
First, valuation discipline. Classic Buffett like PE under 15, PB under 1.5. Apple's PE is 31, PB is 55. Clear fail on the strict numbers. No 25% margin of safety at this price.
But he bought it anyway, so quality trumped price.
It seems so. He likely saw the business quality as justifying paying up, something he's increasingly done for exceptional companies.
Okay, next.
Cash generation and allocation. Huge pass here. Consistently massive free cash flow, FCF margins well over 25-28%, excellent returns on retained capital. Apple is a cash machine and returns tons via buybacks. Total Buffett territory.
Right. Growth.
Growth and predictability. Earnings per share generally rising, but not every single year without fail, so maybe a partial pass. Book value per share has actually gone down.
Wait, down. Isn't that bad?
Not necessarily here. It's because of the huge buybacks shrinking the equity base. It's intentional, boosts EPS and ownership. So context matters. Owners' earnings are strongly positive. Pass. But the free cash flow yield FCF relative to market cap is only about 3.5% below Buffett's ideal 10% fail.
Okay. Nuanced picture on growth. What about safety? Balance sheet.
Balance sheet safety. Formally, the debt-to-equity ratio is high, around 1.7, way above Buffett's 0.5 rule. Fail.
But.
Yeah, the reason the equity is low is the buybacks. And their ability to cover interest payments is incredibly strong, like 30-40 times earnings. Pass. They have tons of cash and liquidity. So while it fails the ratio, the substance is very safe. It's about capital structure optimization, not distress.
Gotcha. Context again. Finally, profitability.
Profitability and efficiency. This is where Apple just knocks it out of the park. Gross margin consistently over 40%. Pass. Net profit margin around 25%. Pass. Return on equity is over 100%. Return on invested capital around 46%. Vastly above typical thresholds. Pass with flying colors. Low depreciation relative to profit, too. Pass. This is the definition of a wonderful business in Buffett's terms.
So summing up the Buffett lens, an absolutely stellar business, but maybe not a bargain stock price right now?
That's a great way to put it. Apple the business. A-plus stack. Checks almost all the quality boxes, spectacularly well moat, profitability, cash generation. Apple the stock. At a $3 trillion market cap, it's priced such that future returns for new investors might be more modest. Not the kind of returns Buffett got buying back in 2016-2018 when it was much cheaper relative to earnings.
And the fact he's holding, not selling.
Exactly. It implies he's very comfortable holding this incredible business for the long haul, given its durable moat, even if he's not adding aggressively at these prices. He found a wonderful business at a fair price back then. Today, it's arguably a wonderful business at a full price.
It really is a fascinating paradox, isn't it? Exceptional quality often commands that premium price.
It does, and it leaves you, the listener, with a question to ponder, right? As you look at Apple's future, where does the true value lie? Is it in nailing the price you pay for future growth? Or is it in the enduring power of a business so fundamentally strong it can shower shareholders with cash while pouring billions into its next potential game changer, like personalized AI for Siri? It really challenges that traditional deep value playbook. It'll be fascinating to watch how Apple continues to navigate saturation, competition, regulation, all while trying to invent the future.